Hey everybody, this is Charlie Dobbins, and I want to welcome you to the next group coaching call. This one is probably one of the first ones moving into a new discussion that you as multifamily investors are going to have to get into at some point. And it has to do with being able to speak knowledgeably to your investor groups. So you've spent all this time looking for deals, and as we've taught you all along, it's a two-part series here. Not only do you have to be looking for deals, you also have to be looking for money. And that part of looking for money means that throughout the whole entire acquisition process, you've been cultivating people, cultivating investors that you can speak to knowledgeably about multifamily investing. Now you've come to the point in your development where you have that deal, and the deal looks like it's going to move forward. Now what you need to do is to go sit in front of those people that you've been cultivating and sell them on your deal. You have to convince them to move their IRA money to your property. And the discussion today that we're going to go over is going to be how to approach those investors so you look like you know what you're doing. And they are going to listen to you talk about the deal and realize this guy's a pro. I want to put my money into his deal. All right, but before we start, obviously my disclaimers as usual. I am an attorney. I'm not your attorney. Get an attorney. And I say that every time because you all know exactly how I feel about that, and I don't want you to misconstrue my representation through the consulting process here as being any form of legal representation. I'll sound and act like a lawyer, but I'm not your lawyer. Get a lawyer. Okay, now obviously, I've done this many times, and I've acquired many properties and have sat down in front of many investors, and I've done the pitch, but I could not have done it if I wasn't sitting right next to or behind my wife, who is the expert at this discussion. And this is who we will be speaking with today. And sitting right here in front of me is my lovely wife, Kate Dobbins.
Hello, everybody.
Hello, Kate. And Kate and I just celebrated our 29th anniversary of our first date for St. Patrick's Day. I made sure I went out with her on a special day like that, so I would always remember the occasion. Otherwise, I'd always forget the first date. Anyway.
Truth is, he's better at remembering that anniversary than I am.
Oh, yeah, because it was a great time. It was,
yeah.
I had a great day that day.
I did too.
Yes, obviously, 29 years later.
A date that will live in infamy.
That's right. Kind of like Pearl Harbor. Great.
Like Pearl Harbor.
Awesome. Now, let me just give you a little bit of background. Kate and I are investors together in our deals, but I am the one that runs the law practice, and Kate runs the business consulting practice. She has her own business. She's got some real estate, some pretty high-end real estate clients who she consults for, and she's got other business owners as well that she works with. Her entire practice is really done to help investors, help business owners maximize their business potential, maximize their businesses, find the profit in the business, and she does that in a very unique way by having the knowledge of how to run a business and how to run the financials of a business. So, but when we were out there buying properties and meeting with investors, Kate was the one who really put together the offering package in such a way that we could easily sit in front of people and get to know them and find out exactly what their investment requirements were and whether we had a fit for them or not. So without further ado, and I'm sure I'm going to be interrupting her quite a bit throughout her spiel because this is just going to be a conversation, I would like to turn it over to Kate.
Hi, everybody. It's great to be with you all today. This is such an important topic. Being able to communicate your business strategy, your investment strategy in a way that exudes confidence and clarity is really what this discussion is all about. In the years that I have been a consultant, I have worked with a couple hundred real estate investors individually, one-on-one, helping them develop their competencies and their confidence in this business. And from my perspective, as somebody who's worked with hundreds of people, this issue around articulating a solid business strategy is one of the most important strategies. It's one of the most vital components of mastery in this business. So the way Charlie talked to me about this call was really prepping an investor essentially for a Shark Tank experience. And that show, Shark Tank, is one of my personal favorites. I love watching the people come in and sit in front of the sharks, quote unquote, and pitch their ideas. And I can tell you from years of being a person like a shark and also being a person that's pitching, I can tell almost instantaneously if the sharks are going to love them or hate them. And it has a lot to do with the level of preparedness and clarity that they bring to the dialogue. This can be a very emotionally driven business. People get very excited about it, but when it comes to investor development, it really has to be led by logic, by financials, by clarity, and solid communication. And the issue around financial clarity is one that trips people up quite a bit. So I want to start by helping people understand really the development of this relationship from a macro view. So as Charlie said, how do you get somebody that has money in their IRA account to go to the checkbook that they got with, that came with their IRA package and write you a check for $50,000 or $100,000 or $250,000 or $500,000 and hand that over to you. Just envision that event happening. And if you were the person writing that check, where would you need to be in your level of confidence in the transaction and in the person that you're handing that check to? That handing the check over is the result of a great deal of effort in developing a trust-based relationship, not only trust in the character of the person that you're working with, but trust in the confidence around the financial strategy. And the financial strategy, really, you don't start with, I have this great deal and I wonder if you're interested. In my experience, you start at a macro level, talking with people really conceptually about what are their investment goals, what are they interested in investing in real estate? If they're interested in investing in real estate, are they interested in doing it individually or in a group setting? And what type of real estate are they interested in? Are they interested in multifamily or single family or office? Or, people have a lot of different opportunities to invest their money. So you have to walk with them and help them, and be very respectful of when you're speaking to a person around what their own personal investment strategy is and what their investment goals are, what their risk appetite is, and what their time horizon is. So I've just hit on a bunch of different issues here when you are starting to filter a relationship at a macro level. Is does the prospective investor, so somebody you meet at a conference, somebody that you know in your neighborhood that said, hey, yeah, I like real estate, we should talk sometime. And then you think, okay, great, I'd like to talk with this person. What's the first conversation? In my opinion, the first conversation goes somewhat like, and maybe Charlie and I can pretend to have this conversation. So I say, hey, Charlie, I understand you're interested in investing in real estate. Why don't you tell me a little bit about what your investment strategy is?
And I would say something or you might hear back from these people something to the effect of, yeah, I heard about a friend of mine who's invested in this type of a deal. And then you just, start questioning them more about that type of deal and seeing that it's multifamily is our objective. You want to quickly find out whether multifamily investing is what they are looking for.
Yeah, so I would say, okay, what do you know about the deal? Do you know if it's commercial, or is it single family, or is it apartment investing, or maybe it's land, raw land?
Exactly, and this is where I always talk about you need to find out the flavor of the person's money.
Yeah.
And this is what we're doing right now, is trying to figure out from the investor, what is it that you're looking for? Because, there was that one time, and I use this example quite a bit, where I had, a guy, a very good investor, told me he had $1 million liquid. And I thought, fantastic, this guy's in my deal. And then when I sat down with him and started having this type of conversation with him, I found out that multifamily was not what he was looking for.
Right.
But we were able to work out another arrangement that ended up being very profitable for both of us. So it can work out.
So, Charlie, if I said to you, what kind of real estate, and you could say, let's say you say back to me, well, he's investing in single family. And then I could say back, so is that of interest to you? Because I do multifamily, and multifamily is kind of like single family, but I actually think it's a better investment.
And the thing that you have to be able to dig down a little bit deeper and find out, well, why did that guy invest in single family, and why does that interest you? And the reason could be, a lot of you people are single family investors, and you know that single family investing is a short-term investment, and the money flips very quickly. And so, or it could be a buy and hold strategy, but sometimes these investors, all they're looking for are, kind of a hard money lending for a single family deal. If that's what your investor is looking for, multifamily might not be the solution. I mean,
right.
Multifamily is always more of a long-term arrangement.
So one of the things that I just, as I'm listening to us even do this role play, one of the things that I want to just encourage you to do is to not force a square peg into a round hole. If people feel like you are forcing and directing the conversation, and that the only thing that you are open-minded to is your deal, your deal, your deal, people will not feel that respected in the conversation. They will feel forced, and when people feel forced, they are not going to open their checkbook up to you. If they feel respected and you're building trust, that's where it comes. And so you have to believe and be patient with the process. And if people that you meet are not interested in multifamily, wish them well in their investing and move on. And because you will find people that are the right fit. And I've had people say yes to me to investing in the deal, and then come back to me and say, I'm a little apprehensive. And I say, you know what, if you're apprehensive, I don't want you in the deal, because it's not good for you, and it's not good for me to have somebody in this deal that is apprehensive. And people have given me their money before we've closed on a deal, and we've ultimately given it back to them and had to go out and raise a replacement investor, because some people have gotten cold feet in the process. And by law or by contract, I didn't have to give them their money back, but we chose to do so because it's just the right thing to do. And that you have to always do the right thing by your investors.
And the thing is, you want to start that conversation before. The easiest time to start that conversation to find out the flavor of their money is before you have a deal on the table. Find out what it is that they are looking for. And a lot of times, if you've got somebody that you want to be their sole, you want them to be your sole investor, find out what kind of deal they will want to invest in, and then go out looking for it. Why leave anything to chance? If your money guy says to you flat out, I am only looking for this type of a deal, A, B, and C, why would you bring them a property that you found that is X, Y, and Z?
Exactly.
They'll look at you like, thank you very much for your time. Obviously, you don't listen very well. I'm moving on right now.
Right.
But the thing is, you can go out there, if that guy's money is looking for an A, B, and C deal, and you're out there looking for an X, Y, and Z, keep your eyes peeled for an A, B, and C. Mm-hmm. There's another opportunity for you to make money there. So, to have that conversation with the investor before you have a deal, that will really help you focus the right way on finding the right property.
Correct. Charlie makes an excellent point here. So one of the first things that we always do with people, prospective investors and multifamily investors. I know Charlie does this through the Multifamily Investing Academy, and I always would do this with my clients, my real estate investing clients, is we would develop an investment strategy that made sense for them based upon what their individual profile was, and also based upon maybe what the investment profile is of their prospective investors. What I've learned in all of my years of doing business consulting and investor, multifamily investing consulting, is that it has to be a sweet spot both for the deal sponsor and for the investor participants. And if it's not, then it's a bad fit. Some people will only invest in A properties because they want low risk, perhaps likely lower yield, because lower risk is lower yield. Some people are very interested in C properties that should theoretically throw off more cash-on-cash return, but the risk profile is higher. So there is a risk-reward scenario here. And as you are developing your own investment strategy, it's important that you understand what is the flavor of the deal. Charlie has used what is the flavor of an investor's money, but really what is the flavor of your investment strategy yourself, because what are you comfortable with? And it's a lot easier if you go out and tell people, well, I don't know what I'm doing. It doesn't build confidence. If you go out and you start asking people, saying, so what's your appetite? And you don't necessarily divulge, say, I'm just early, I'm developing my strategy here, I'm researching some markets, I'm starting to look at a lot of deals, I'm early yet, I have not yet formulated with total clarity my investment strategy, but I'm kind of testing the waters. That's a legitimate thing to say. But once you're coming back and having a second or maybe third conversation with that prospective investors, you ought to be crystal clear about what you're going after and why. They want to know that you're able to lead with clarity and say, you know what, I've looked at some emerging markets, I've looked in my own backyard, and from my standpoint, because I have this is just a hypothetical scenario, but I've seen this one quite a bit. Because I have a full-time job, because I have kids that I need to take care of and I'm responsible for them after hours, you might be thinking, I really don't have as much time as I would like at this stage to be spending, 40, 50 hours a week on this. Realistically, you might have 8 to 10 hours. And so with that strategy, you might say, you know what, I really need to be in my own backyard. I need to be within a 2 to 3 hour driving radius of my home, and that's my marketplace out of the gate, because I've got to be able to go and see these properties, intervene if there's a challenge, kick the tires, etc. It's a way to mitigate a lot of the risk, is that if you can see, touch, feel the property and get to know it, get to know the market intuitively. And if you go back to your investors and say, you know what, I'm interested in doing somewhere between a 10 and a 50 unit deal within 3 hours of my home base, and I'm researching these markets and I'm looking for, B to C plus properties, because the amount of risk is mitigated by the yield here. I think it's a really good target, and I need to raise, $750,000. So the amount of clarity that brings, I'm sure if you're even listening to me, it sounds good. It sounds transparent. It sounds legitimate, and that's what people want to hear, is that it's a very tight, defensible strategy. Not only will that build trust with your prospective investors, but it will build trust with your brokers as well, because brokers, you've got to understand, brokers get paid when the transaction closes. They want to work with people that are clear in their investment strategy so people can be decisive. If brokers sense that you are all over the map, they're not going to want to do business with you, because it's going to take way too long for them to get paid, and they're going to work with people that are clear.
Now, the thing that I want you to understand, and I've said this before, is that though we talk about the acquisition of multifamily property, what I want you to think about more is the fact that you are really starting a business here that is a real estate investment management business. Not a property management business, but an investment management business. What you're doing is you're managing investments in the form of multifamily property. So as the owner of that type of business, you've got to think to yourself, I've got to put out a face to the marketplace that shows I know exactly what I'm doing. So when you're sitting down in front of these investors, and 1 week you're showing them a bombed out shell of a building that requires full rehab over the Rhine in Cincinnati, and then next week you're showing them a Class A property down in South Carolina, they must be looking at you thinking, well, what's this guy's practice? What does he do on a regular basis for looking for these types of properties? I mean, he's just shown me two different scenarios, two entirely different scenarios of investment opportunities.
Right.
What's his mindset? What does he think is a good opportunity? You know, and believe me, there are people that will invest in over the Rhine D-class property, and that's their strategy. And then there are others that will only touch A and B class property in, you know, in growth marketplaces. So you need to figure out exactly what your investment philosophy, what your company's investment strategy is, and then focus on that. Be an expert at that level.
Yep. So I think, you know, tying this back to the Shark Tank concept. So just as a side note here, for those of you that have never watched the show Shark Tank, it is definitely your homework assignment to go watch a couple of shows. It's really good entertainment, but it will give you some real examples of what it's like to raise money. And I, just by way of background, for me, I worked in commercial lending for a long time, for 10 years, and then I worked actually in venture capital for a couple of years, and I know what it's like to be pitched. And the opening dialogue when somebody comes in, the way they present themselves, you know, this issue around clarity is one of the most important things. It's stepping out in confidence is really essential. And once you start watching Shark Tank, you'll see it, and you'll see the expression on the people's faces consistently. So clarity of strategy is vital. Knowing your numbers is vital. Knowing your audience, which is what we've been talking about. Who are your investors? What's important to them? Knowing your audience and speaking to them. Don't make it difficult for people to say yes for you, you know, to say yes to you. If you go at them with this really discombobulated, I'm all over the map strategy, they're going to be polite, they're going to nod their head, they're going to wish you luck, and you're never going to hear from them again because they've lost you, or you've lost them, and they're thinking about their kid's soccer game. And so you have to make it easier for people to say yes, do the work for them.
You know, I think your comment about homework assignment being watching that show, I think, what do we watch it on Netflix or something? You can see it one right after another, and, you know, or
I don't know,
one of those types of things. But that is a great homework assignment. And when you're watching it, what you have to think about is that that's going to be you.
Right.
Sitting there pitching your deal to the Sharks.
Right.
I mean, the Sharks might not be, you know, a billionaire Mark Cuban. They could be a little old lady who, you know, has a bunch of money under her mattress. She's your shark. So you've got to understand what you need to do to present your case to them. And, you know, that's when we were investing and raising money. What we would do is every time we had a deal, we would go see this one particular investor first. He was our ultimate shark. This guy would look at our package, would rip through the numbers, would tear the deal apart, and we knew that if we could make it through that guy's analysis, we had a pretty good thing going. And that's how we started going after our deals and making sure that if we made it past this guy, our business is going to look professional every time we move on forward after that particular investor. Yeah. So that's how you need to look at this.
That's a really good point. We did, you know, have people that essentially, you know, vetted our deals, and I was always a little nervous going and speaking to this one guy because he was always, let's just say, he was very.
He was a shark.
He was a shark. He is a shark, and. It's like I could totally trust his feedback, you know, positive or negative.
Yep.
And he didn't hold back, which was great.
Yeah. You want that. You want to have that audience at some point.
And if you ever wonder, you know, I mean, Shark Tank is a reality TV show, and so many of the reality TV shows are totally contrived. Absolutely. But Shark Tank, from my experience, having worked in venture capital and working on the, you know, on the money side of things, it's accelerated, like the whole, you know, dialogue is very compressed, but the questions that they're asking, their thinking, the way they're approaching things, it's straight up. I think it is, it's not contrived. The questions that they're asking are legit. When it comes down to brass tacks, these people want to know, does what you're offering meet with their financial strategy? And to think otherwise and try to kind of win your way on emotional hype, it's just not going to work. So we've talked about knowing your strategy, knowing your numbers, knowing your audience. Part of that is knowing the risk profile of both your audience and what the risk profile of the deal is that you're bringing to them. Another very important thing is being transparent so that you can present numbers and information in a way that is clear and concise, not overly verbose, but makes people feel that, you know, you're not holding back, you're showing them the relevant information, you're not manufacturing the data. And you always have to know what is your exit, and they need to know what is the exit. Are you asking for a 3-year commitment? Are you asking for a 7-year commitment? You know, obviously when you do your legal documentation, they can't force you to a time frame, particularly if they're coming in on an equity position, but you need to be sharing with them what your intended strategy is. And so that, again, you know, there's a management of expectation. Certainly, you know, when people bought property in 2007 or 2006, there was a lot of folks that had short-term investment strategies of maybe 2 to 3 years. Then the market crashed. Everybody's strategy completely changed at that point because the market conditions, you know, did a 180. So, you know, market strategies can change as business conditions change, but you need to be clear about what is the in, what are they getting into, and what is the out. You know, professional people expect that. Part of showing up with clarity and confidence is all that I've already said, but it's making sure that you've got a solid team with you. You should have a lawyer on your team. You should be able to articulate who the brokers are that you're dealing with. But certainly saying, you know, I am working with an attorney. I've already, you know, this is how I'm covering my bases. There are a lot of early stage investors that, excuse me, cut corners because they're trying to cut costs. And they maybe, you know, and if this is you, I'm talking exactly to you, putting out LOIs or purchase contracts that have never been reviewed by an attorney, or trying to get through a due diligence or an inspection process without hiring professionals. This is a huge mistake for a lot of reasons. If your investors find out that you are cutting these corners, it will diminish their trust, and the likelihood that you will convert them to investors will quickly evaporate. They need to know that you're the kind of business person that sees the wisdom of using third-party professionals to protect their investment. And if you don't have the ability or the wisdom to do that, then it's, like I said, it's going to diminish trust. So, and it increases risk because most of you are not lawyers, most of you are not, you know, site engineers or building inspectors, et cetera. So approach the business professionally. This is not, you know, it should not be a DIY across the board type of approach, particularly if you're bringing in other people's money. So you really need to think about this, you know, put yourself in the shoes of the prospective investor when you're thinking about your own strategy, and the way you articulate this is this move going to build trust, or is this move going to diminish trust? And if you're not sure, call somebody and ask them. Say, you know, does this help you get, you know, trust me more, or does this help, you know, or does this keep you from trusting me? And talk to somebody who will be honest with you about that, because it's really important.
You know, I always use the example, you know, picture yourself sitting on a witness stand answering the judge's questions, and they ask you the question, did you hire a professional to inspect this property? And you say, no, I didn't, because we didn't have the money. That just makes you look like a weak witness. And that's essentially what each investor needs to be asking of you. Are you doing this? Are you acquiring this property in a professional manner? Are you taking my retirement money and making good stewardship of it, and by making sure that all the T's have been crossed and the I's have been dotted on this transaction? And, you know, I tell you, we've been through good deals and we've been through bad deals, and we've handled them all the right way. And because we've done it right every step of the way, even if a deal went south, we were always able to say, hey, you know what, we did everything we possibly could. There's risks involved with any type of real estate investing, and this was, you know, we were the victims of that type of risk. But we still transacted our business in the right manner.
Okay, so we've talked, I think, somewhat comprehensively about the experience of going into the Shark Tank and pitching your deal. And my experience is that once I have these discussions with people, a lot of people that I tell this story or this technique to end up feeling very deflated by the end of it, because they think, I don't know my numbers, I'm not confident in this, I don't, I'm not silver-tongued in the way I communicate with people, I don't have the confidence to go forward, it all sounds good, Kate, but I'm not there yet. So what do I do? And do I wait until I'm completely polished? And I don't think I'm ever going to be that polished. So I feel you. I feel your pain on that, because going out and pitching to investors is a skill that you can develop. And you don't have to come out of the gate and go into a Shark Tank. You don't have to come out of a gate and go into a Shark Tank. You can start where you are comfortable. For some people, going out and raising money from investors is where they're comfortable. For the majority of people, they're not comfortable with that, and they need to build some muscles and build some confidence around this. And the way to do that is to get in the game, start investing where at your comfort level. You might be thinking, yeah, I'd love to, I have a vision of going out and doing this, but it gives me the sweats. I can't do it yet. So go out and start small. Buy a 3-family, buy a couple of 3-families, and become an owner. Start a smaller business. Invest your money only, or maybe work with one other partner who you find the deals, and your partner brings some cash into the deal, and get your feet wet. Because what will happen is that you will learn, and when you learn from your successes and from your mistakes, that's how confidence is created in a human being. It's through experience. So starting where you're at makes sense. And it's tough when I see this all the time. It's tough for adults to be willing to admit that they don't know what they're doing, and to feel clumsy in a sophisticated business situation. So permit yourself the opportunity to crawl before you walk, and walk before you run, and run before you sprint. And before you know it, you will be, if you give yourself a year or two to start small and get comfortable, you'll be amazed at how quickly you can progress through this, because confidence attracts confidence. And if you're out there shaking like a leaf, your prospective sharks are going to know that. One of the most important things, and you'll see this when you watch Shark Tank, is that they always ask, so what are your sales? What are your numbers? How are you doing? How's the business doing now? What they're looking for, it's this concept in investing called proof of concept. They want to know that they're not investing in a brand new rookie idea. They want to know that you've been able to create some momentum on your own, that you've been able to execute. And if you go out to your investors and they say, so what have you done in real estate? And you're able to say, I've owned a couple of 3-families for the last couple of years. I really have mastered my understanding of landlording. I understand collections. I understand leasing. I've gotten these things financed. I've raised some capital. I've been able to pay some returns to my investor. That conversation, they're going to say, wow, okay, this person is, walking before they run. And that is one of those things that I said earlier helps build trust. It's proof of success in your, it's proof of concept that, yes, here I am, I'm a real estate investor, I've proven that I'm able to do this even on a smaller scale. I want to go larger scale, and I'm attracting more capital to take me larger scale. And that's one of the things that you will see over and over and over again in Shark Tank. They chew up people that say, this is just an idea. You don't have proof that you can do this. I'm not interested. So this proof of concept is a big piece of investor success. So
there's just so you all understand that you can pick up this, you can see what we did in order to raise private money. There are 2 tools that are available to you from the Owners Forum, the Masterclass Forum. First one is that the cash flow analyzer has a marketing package to it. So when you use the cash flow analyzer and you insert the numbers into that document, what that does is it can create a marketing package about the property right from the very, very beginning. That's why you always want to put the information in correctly. Junk in, junk out. Make sure that you're inputting all the right units, the right number, what the rents are for each unit, because all of that information is going to spit out a beautiful marketing package for you at the end of the by hitting that last print button. That's what the cash flow analyzer does for you. In addition, if you go onto the resources and archives section of the membership site, there is an offering memorandum template that we use to raise about $2.5 million for one of our deals. You can go dig down there. You can find it. It's about a 70-page document, and you can see exactly how we built our offering memorandum for our investors and what we did in order to get them to commit money to us. And either one of those two packages are fantastic. But let me just tell you this, and I'm waiting for Kate's reaction to this, and it was amazing. If you look at that big, beautiful offering memorandum that we used on one of our properties, there's a page in there called "What's in it for you?" And then on the other side, on the cash flow analyzer, I was out speaking in LA, and I had attorney Jeff Lerman come and speak to our group. He showed us a property package that he put together for one of his deals. Unbeknownst to me, he also uses the cash flow analyzer. He was using the exact same software that we were using in order to to raise money. In his package, he put together a page, and he entitled it, "What's in it for you?" And in the meeting, I said, I can't believe you're doing this. And I said, let me ask you something. When you sat down in front of these people and asked them for their money, and you handed them this package, what page did they look at? And he came up with the exact same answer that my wife and I came up with. Everybody goes to that page that says, "What's in it for you?" And that's what they all looked at. And so you want to go find that offering memorandum on the resources and archives section and see what that page looks like. And you'll understand now that's what the sharks care about. Mm-hmm. They go right for that particular page.
Yeah, I remember putting that property package together, and that was always the page that people went to. I mean, when you're putting the information together, as I was saying earlier, transparency is very important. Clarity of communication, that you're building a well-constructed strategy that's defensible is very important. You're showing them the financial analysis is very important. So the way we did that is we did a couple of different scenarios. So when you build a property package, you take in the information that the sellers are giving you. That's your baseline. And then you think, what is it, my property management strategy, is it going to augment these numbers? So you can have essentially a value play scenario, so it takes the numbers and it improves them. It's also important to say, what's our worst case scenario? What happens if we're unable to perform and this thing actually goes down? And you really stress the financials so that you look at it under a tougher scenario. So you're providing a range of potential performance. And I think that's very important, again, for building trust, that you're not saying, it's always coming up roses and sunshine on this property. There are a lot of variables that can happen that are unexpected, and people understand that. But I also think that if you are willing to communicate that this can go very well or this can go badly is important as far as building your own integrity and helping people understand thoroughly the risks that they're getting involved with, so that they're walking into the transaction with their eyes wide open. That's very important. But all of that aside, you might be sitting there thinking, okay, that makes sense, that makes sense. Then it's really great to take that information and boil it down. And that what's in it for you, what I did there is I said, okay, if this property produces a 10% cash-on-cash return and somebody invests $50,000 and they stay in the deal for 5 years, what does that look like for them, dollars in their bank account. If it shows a 12% cash-on-cash return and they're in for $50,000 and they're in for 3 years, what does that look like? So it's a scale so that people can actually say, wow, if I invest 50 and it performs well, I could be here. Or maybe I want to invest 150. So it's a grid that essentially lays out what the yields will be for people based upon different sets of assumptions. And it is, and the assumptions are tied to the actual pro formas that are in the document. And I learned that from actually a somebody else. It's not, it's not original thinking on our part. But remember that when people are going to their IRAs and they're thinking about investing $50 or $100 or $250,000, it is a demonstration of trust. They have worked very hard and performed well in their own professional life to be able to put that money aside, and they're very interested in what's in it for them. They're less interested in what's in it for you, but they're very interested in what's in it for them. That's why people invest. They're looking to grow their income. They will ask you questions about what your stake is in the deal. They definitely want to know what that is and if they feel like it's fair. If you are overreaching in the deal, if you're pushing to own too much or get paid too much, again, those are one of those things. They're trust busters. There's not a sense of fairness in it. They want to know what your risk level is. They want to know what your commitment level is, etc. So,
and let me just say here, because I know there are a lot of new investors on this call listening to what Kate just said, and I don't sell yourself short. Your time is valuable, and you want your time you want to be compensated for your time. So if you put in there a 2 to 3% acquisition fee and somebody questions it, don't cave. Don't just say, oh, you know what, I'll give that up.
Oh, good point.
That's your money. You earn that money. And let me tell you something. You're going to earn that money going forward.
You bet.
And let me tell you, there's a lot of talk. Everybody loves the idea of an acquisition fee. Well, how many people think about a disposition fee? That's another fee that you should put on the back end of the deal so that you get paid on the exit. Because selling a property, getting a property prepared for sale takes an awful lot of work, and you should be compensated for that work as well.
That's right. I think Charlie makes a good point, and I'm not in any way saying that you shouldn't charge a fee to put the deal together or deserve to be compensated for all the work of constructing the deal and then babysitting and managing the deal over a period of time. Remember, so much attention is given towards the acquisition and the acquisition process and then the financing process and the closing process. But quite honestly, that is, it's maybe the first 6 months, and you can own a property for 3 years, 5 years, a decade, or longer, and that's a very long period of time that this is becoming part of your life and your responsibilities. And if you're the managing member, that responsibility doesn't go away. You are the fiduciary, and you show up for that, for the good, the bad, or the ugly. And so making sure that you're structuring your compensation appropriately, because your responsibilities in no way go away once you acquire that property. If anything, they increase. So I know we've hit you with a lot of information, and first and foremost, I am so glad that I've had the opportunity to talk with you. If this feels overwhelming, my encouragement to you all is that, I also had to learn how to do this. A lot of people that I've worked with have learned how to do this, and the best thing to do is to get around people that have done it before, get some advice, and then stop walking around the pool and sticking your toe in the water. At some point, you got to dive in, and just if you don't want to dive into the deep end, walk into the shallow end and find the deal that works for you and get in the game. That's the best thing you can do, and you will learn this stuff. This call, I think, is going to be recorded, and it will be one that you can come back to a bunch of times and get your questions over here as well, because this is one of the most important issues. And I know that Charlie's goal in this is really being a resource for honest, straight-up answers, good, solid advice that's appropriate for you individually, not necessarily for the masses. So it's fun to be here and to talk with you, and look forward to being a resource to MFIA in the future.
Great. Thank you so much, hon. And if anybody has any questions, you can shoot us an email at info at multifamilyinvestingacademy.com. And I know where she lives, so I'll track her down and get her to answer your questions about how to handle the sharks that you will be facing. Just expect it, and hopefully this audio was the first step in your understanding of how to approach this business. So everyone, I want to thank you very much for your time, and we will watch for the next group coaching call, and also don't forget the offer writing workshops once a month, and we'll talk to you later. Thank you so much.
Thank you. Bye-bye.